He sold financial products that barely existed, generated millions in commissions, and served less time in prison than people convicted of minor crimes. The system worked exactly as designed. To understand how that happens, you have to start long before Wall Street, before crime ever entered the picture. In the summer of 1980, Jones Beach meant heat, crowds, and limited access to drinks. Jordan Belfort noticed the pattern. The same discomfort at the same time, every day. While other teenagers spent the afternoon in the water, Jordan moved through crowds with a cooler, selling ice to people who wanted immediate relief. Every sale happened at the moment discomfort peaked. By the end of the season, he had accumulated roughly $20,000 in cash. After the beach, he started measuring opportunities by how fast they paid. Dental school promised stability, but only after years. During orientation, a dean explained that insurance companies had capped earnings across the profession. For Jordan, that timeline was already unacceptable. He left before classes began. Selling meat and seafood door to door became the next move. Problems multiplied through spoiled products and delayed payments, with each sale creating work that didn't end when the deal was made. Transport created dependency, and decay punished hesitation. Jordan learned something practical. The more physical the product, the more control shifts away from the seller. He needed a product whose delivery bypassed storage, decay, and the passage of time altogether, something with fewer constraints. In 1987, Jordan entered Wall Street through L.F. Rothschild. The trading floor rewarded speed and volume. Brokers sold large, established companies like General Electric and Coca-Cola. Names followed closely by institutions and media. Then the market collapsed. On what became known as Black Monday, the stock market crashed in a single day. Firms cut risk instantly, closed positions, and eliminated anyone they didn't need. Jordan was laid off. The system protected itself first. He found another company, still Wall Street in function, but far from its center. A small firm operating out of a strip mall. They sold extremely cheap stocks that almost no one followed and almost no one could verify. These weren't the kinds of companies you could look up on the news. There was no easy way for buyers to verify what they were being told, since the phone call was their only source of information. What the buyer didn't know was that the person on the phone was never planning to hold the stock, only to sell it, collect the commission, and move on. Because these stocks were considered high risk, the firm kept 50% of every sale. Convincing someone took the same amount of effort, but the payoff was completely different. Compensation arrived the moment the transaction cleared. Jordan adjusted his approach. He stopped explaining companies and started managing hesitation. When buyers questioned risk, he reframed delay as loss. At that point, the details of the company no longer shaped the conversation. The same pitch could be used regardless of what the business actually did. What mattered was creating the impression that the price was about to move, while hiding the fact that the same people selling the stock were also controlling when and how that movement happened. At that point, persuasion is legal. Even selling risky stocks is legal. What crossed the line was omission. The people on the phone weren't acting as neutral intermediaries. They were presenting themselves as advisors, while withholding information that would have changed the buyer's decision. Clients were never told that the firm already owned most of the available shares. They weren't told that the same brokers urging them to buy had already planned when to sell. In financial markets, that information matters as obligation. When a seller has a direct financial incentive tied to the outcome of the advice they're giving, that conflict has to be disclosed. When it isn't, the transaction stops being a market interaction and becomes a misrepresentation. The crime wasn't that the stock went down. Stocks go down all the time. The crime was that the risk was selectively hidden, while urgency was amplified. That's where the system breaks, when trust is manufactured without disclosure. What made this structure hard to stop was fragmentation. Each client only saw a single phone call. Each trade looked isolated and personal. No individual investor could see the pattern forming across thousands of accounts. Once the sale closed, the seller won. At this stage, the system itself punished hesitation and rewarded speed. To increase volume, Jordan built Stratton Oakmont. He recruited people without financial backgrounds, prioritizing compliance and urgency over expertise. The environment enforced confidence through repetition. The system trained participants automatically. Eventually, selling existing penny stocks wasn't enough. The price still depended on supply they didn't fully control. Real leverage required starting before the stock existed in the market. That's why Stratton moved into IPOs, the moment a private company becomes public for the first time. In that moment, prices are fragile. Whoever controls the initial supply has disproportionate influence over what the market thinks the company is worth. Before the companies went public, most of the shares were quietly split between people connected to the firm, friends, and relatives. On paper, it looked like many independent owners. In reality, the same group still controlled almost everything. When the stock launched, brokers created synchronized demand through mass outreach. Prices rose rapidly because attention moved in one direction. Movement became validation. The structure didn't require belief to last forever. Only long enough for money to change hands. At this point, patterns had formed. They were not yet visible to outsiders, but repetition leaves residue. The operation required continuous inflow to sustain itself. Pausing meant collapse, and with that, scale created dependency. Eventually, the volume of cash created a new constraint. Banks were required to report large cash deposits automatically. Traceability meant exposure, even if no one was looking yet. To limit how much could be reconstructed later, Jordan organized structured deposits, breaking large sums into smaller transactions across multiple banks. This worked until it didn't. As the volume increased, even that system strained. When banks became too risky, the strategy changed again. Money stopped moving through accounts and started moving through people. Carrying cash across borders kept it off the books, but it also made every transfer fragile. The pattern itself became visible. The same movements, the same amounts, appearing again and again across different places. Federal investigators reconstructed activity through transaction patterns and account behavior. Cooperation became rational. Associates provided information to reduce their own risk. Jordan responded as he always had. He traded what he had left to limit loss. After serving his sentence, he returned to public life selling stories instead of stocks. Attention replaced money. The system didn't stop him. It simply gave him a different outlet. As long as effort is rewarded immediately and consequences come later, the behavior doesn't disappear. It just changes form. If you want to support this channel, consider subscribing. Thank you for watching and stay curious.